Welcome everyone to SMSF. Is it the right choice for you? I guess what I wanted to go through tonight a bit about what is a self-managed super fund, and also to just go through some of the aspects on a self-managed super fund and whether is it the right choice for you. And it really does come down to what your personal circumstances are. And I know there's a lot of people who have been contacting us, especially over the last month or two, given everything that's gone on with COVID and really wanting to take control of their super and the situation. So I really just wanted to go through some of the different aspects of a self-managed super fund and how we can help you with that, but also looking at, well, is it it's not really a one size fits all for everyone when it comes to a self-managed super fund. And, and it is something that comes down to what you are looking for from an investment perspective. So just to go through and introduce, I think I know nearly all of you, except for probably two people that are in there. So just to introduce myself, Shannon Smith, obviously many of you know me as the accountant with Smart Business Solutions. I'm also a qualified financial advisor. I have finished all of my qualifications under the new, what we call the FASIA, which we have another few years deadline. I did finish it in record time, which was a few uni subjects, master's subjects, but just to get that all done. And so financial advice, they changed the rules a number of years ago, back in 2016. Prior to that, accountants could give all of this advice and we didn't have to go through all of these different ASIC requirements. So when the rules changed back then, I did make the choice to become a licensed financial advisor because I have so many clients that I work with that are always interested in self-managed super funds. And I felt that if I wasn't able to assist them with the self-managed super funds, I'd really probably feel like I had my wings clipped off or I couldn't provide that full service. And I really think it is something when you're looking at holistically with clients. I have also on the call, the webinar tonight, Bianca. Many of you might have come across Bianca as we've been dealing on the financial planning side. She is a financial planner in training. She is currently doing her master's in financial planning at record speed, 2 master's subjects at a time, and is currently got an average of over 80% as her final result for every subject. So she's halfway through. So she is going through record timing on that. So I have good support around that as well. So let me just get started to go through the important fine print that we need to say. This whole document is basically general advice. It may not be tailored to your situation. So it is general advice at this point. What I want to go through today, what is a self-managed super fund? How does it work? What are the costs associated with that? What's an investment strategy? How you can take control on it, and then how we can help in going through. And, when it comes to planning for your retirement, your superannuation strategy is really going to have a major impact on your savings and what kind of lifestyle that you can basically have at the end of it. And a lot of I call it the fun that we have is actually working with clients to identify how they can enjoy today whilst still looking for the future, putting money aside in superannuation, whether it's a retail fund or a self-managed super fund, but really having the end goal in mind of, well, what does retirement look like? What do you want to enjoy at retirement? What funds what's your goal? And then from there, I look at it and say, okay, what do I need to do today to help them achieve that asset base to get that overall goal? And I guess going through what a self-managed super fund is really have a look, is that the right option for you? Maybe a retail fund is the right option for you. So I just want to go through what are the differences between a self-managed super fund and a retail fund? What are the costs involved? What do you need to do? Because all of a sudden you're the trustee of a self-managed super fund, just so that I can really help you, understand if that's something that is the right choice for you. So what is a self-managed super fund? I guess like it's called, it's self-managed. Now, when we say self-managed, you actually might get us to assist you in managing it. But what are some of the differences between a self-managed super fund versus the other funds? We call these traditional super funds, we often call them, I guess in the finance world, retail funds, meaning that all consumers may have that. And that might be something like your Australian Super, your MLC, and one of those. If you're in a self-managed super fund, then you are both the trustee of that self-managed super fund, whether it be in a company or individually. We, and I'll talk about that later, have a preference for a company. There's a lot of reasons why. But you're also a member. So if you think of your retail super fund now, such as one of the big super funds, they invest in assets. And then at the end of every year, you get a member statement that says, we may have 1 billion funds invested and here's your member balance. A self-managed super fund is much like that. You have an investment pool, and depending on how many members you have, which might be yourself and your partner, maybe, you know, brothers or sisters, children. So depending on the number of members you have, but basically in a self-managed super fund, you have control over the investment strategy and the decisions. And that's what I think a lot of our clients like, and especially when they're looking at buying actual business real property. So like the, you know, the factory that they want to run their business from, maybe they want to invest in residential property, and that's something you couldn't do with a normal retail fund. You are legally responsible for the fund. All of a sudden you are the trustee, so you are legally responsible. Whereas when you're looking at a traditional fund, you actually hire a manager and they're responsible for making sure of it. You need to appoint auditors. Obviously we assist you with that, but the government requires a self-managed super fund has an auditor to come in. So not just us preparing the accounts, they actually require an auditor to come in and make sure you're not treating it as a slush fund, that you're spending money in your super fund on what you should be spending. So they do require you to have every single receipt and to make sure that you're spending the funds in the right way. So we engage those independent auditors and they will check that information. The individual trustees carry all the compliance risk, and this is one of the reasons which I'll talk about as to why nowadays people don't set up individual trustees. And you will have to buy insurance. Now, those of you that might have a traditional retail super fund now, they will often just offer insurance cover, lower premiums. It's what we would often call a group policy. So it's not usually the greatest of the insurance policies, probably better than nothing. It may not give you the cover that you want. When you close that fund, all of a sudden you don't have those insurances like your life and TPD. So you will need to look at buying those. From either fund, you can get yours, you can make your super contributions, you can get your benefits upon retirement, and they're also, you know, upon death, there is the death benefit. So from that perspective, that part's the same. It's just about how the fund is overall managed. And in a traditional super fund, you are paying a trustee to be the trustee for you, because you're just a member, you're not the trustee. You're paying them to also then manage the investments and manage your overall fund. So there's always that tipping point as to when is it that you would then be looking at going, you know, a self-managed super fund versus some of the others. Some of the benefits that we have when you're looking at the pros of a self-managed super fund, there really is greater control. You know, we have clients that sometimes, you know, they might buy one property and then like, okay, now my goal is in 2 years, I'm going to buy another, and that's what I want to buy. This is what I want to invest in. You do have a wide investment choice, and that's something working with, when we're working with you, you don't want to put all your eggs in one basket. You know, you want to make sure that you do have a wide choice of the investments and how you might spend your money on that. It does give some estate planning flexibility in a self-managed super fund. So traditionally, you could have what we call 4 members of a self-managed super fund. Now, when you think of an Australian super, how many members there would be in that? But with a self-managed super fund, we were restricted to 4 members. That's being increased to 6 members. I think it's been passed at one level of government. It's just got to go up a few more ranks. 6 members, the opportunity with that, and I can say actually my son, who's now just started at KFC 6 months ago, he's super fund. He's part of our super fund. Now he thought, great, I get part of my super and part of my husband's super. Sorry, that's not how it works. He has his member balance of probably $2 at this point. And so you still have your member balances, but the benefit, I look at it from that side, is now, and especially with 6 members, that does enable families, you know, with more than just say the 2 kids and having the 4 members, in having additional members coming in, and you've got one pool of costs being the costs of maintaining the fund, and now you're able to have other family members up to the 6 coming in. You can borrow to invest. Now that wasn't always the case. Up until, I want to say 2010, 2011, you could not borrow to invest. So a super fund had to have the money in there and then actually invest at that point. Now you can borrow to invest. So the deposit that you are required in a super fund is significantly more than any other borrowings you would come across. Generally speaking, you need to have about 30% deposit. So you need to have funds, and then the super fund can actually borrow. There are some structuring around how that works, but they can borrow. So say you wanted to buy, whether it be a property, you might even want to invest in certain shares, you can actually borrow to invest, and that really helps build the balance up for the future if you've got quite a decent time frame until retirement. Some of the cons is, you now do have what I would say significant trustee obligations. Now, if you're really good at maintaining information, like what we want from a perspective of accountants, and this would be the auditor, is that basically every transaction that you have going through your super fund, because you will now have access to your super fund's bank account. You can pay bills from your super fund's bank account. We need to keep copies of all of those documents. So there is the time on your side and just maintaining those documents, and then the cost of administration. So we help a lot of clients on that side. There's the investment management. Now, obviously, that's something that we can help clients with. Some clients actually love the investment management because they may have some parts that they invest in, maybe even in a managed accounts, and they get us to manage that. But they may have we've got some clients who have a pool of funds that they call it their little trading account, where they play on the stock market in trying to, and investing in their own super fund. Now, you do need a larger super balance to be able to have a self-managed super fund. Basically the requirement around that is really looking at the cost factor of is it financially viable for you to have a self-managed super fund, or is it more cost effective for you to keep your money in a retail fund and pay those amounts instead? So when you're looking at is an SMSF right for you? Some of the things we look at: knowledge of tax and super laws. Now, I know no one's going to love tax and super as much as we love it. We do, when we set up super funds for clients, we just go through some of the key points. I guess you could say little rules of you can do this, you cannot do that, and help you maintain that. You need to have a level of comfort in choosing investments. We may recommend some, but you also may actually decide, well, I actually want to invest in, this property that I'm going to run my business in, and that's going to give you, at least you're paying your mortgage than someone else's mortgage. There is time needed to set it up, and then the managing. There is a high degree of personal legal responsibility. Ultimately, whilst even as accountants we can help you with it, you are the trustee, so you are ultimately legally responsible for making sure that you lodge your tax returns, that you don't use the funds in your bank account for anything other than superannuation. So you can't say, oh, I'm a bit short in the business this month, there's money in my super fund's bank account, I'm just going to borrow that and then put it back later. You can't do things like that. And, potentially you might need some guidance from a financial advisor on how you want to invest and also just maintaining it. So some of the steps when we do go through setting up a self-managed super fund, a self-managed super fund is actually a trust. So we basically establish a trust and create a trust deed. We complete all the paperwork. Now, one thing when we're creating this trust deed is we do need a trustee. The trustee can be an individual or a company, and I'll talk to that in the next slide. And then we complete all the paperwork and we can set that up for you. You get a tax file number and an ABN for the super fund, lodges with the ATO, opens a bank account, and then roll over your super fund. Now, frequently, and I know there's someone on the webinar who's going to chuckle when I say this because it was them last week, but this happens a lot. Frequently, we have clients say, hey, I found a property that I want to buy and I need that super fund set up. We're very used to that. So this gives you an idea of some of the time frame of what needs to happen to be able to get that done and to get that advice document prepared for you. The advice document is going to be required if you're going to be getting funding, because basically now a self-managed super fund, it's considered financial advice. So as an accountant now, I am not allowed to advise you to go set up a self-managed super fund without having prepared an advice document, because it's a financial product. Is this financial product the right product for you? And that's part of the rules that changed, and why I was, went and got my financial planning license, so that I could still work with clients and advise them of that. So choosing the structure, and this is something I go through, our recommendation is always going to be to set up a corporate. Now, if we rewound this 10 years, a lot of people set up individual trustees of their self-managed super fund. So you may still, if you're speaking with any family, friends, they may actually say, look, I'm the trustee. You don't need to set up a company. That there have been a lot of challenges now, that I guess you could say the ultimate recommendation from all advisors and even recommendations from ASIC is that you have a company as the trustee. There are concerns on, firstly, if there was anything to go wrong in the super fund, all the members of the trustees are all liable, and so therefore if there was a fine of say $10,000 and there were two trustees being the two individuals, that would be $20,000, whereas if it's a company, it's just one lot of the fine. The other big issue that we have on the corporate as well is upon the death of one of the members, is that you only have 6 months to change the trustee. And we've had a few instances where we've had new clients come to us not realizing that, and it's been more than 6 months, because honestly, if your partner dies, probably the last thing you're thinking in that 6 month period is, oh, I better go and get my super fund updated. That's probably the last thing you're thinking of. So that's where the corporate trustee is beneficial. Just looking at in managing on a day-to-day basis, you can do some parts of it yourself. And so we do have some clients that may do some of the bookkeeping. They may actually do even lodging their BASs and do some of those. So we kind of team with clients depending on what they require on it. The auditor needs to be an external auditor, so we can arrange that kind of thing as well. Trying to manage on the cost side of it, again, going back to the individual and corporate, the only reason I bring this up is that there will be a lot of historical funds that have the individual. It is a lower upfront cost because you don't have to set up anything. You are already a legal person, whereas a company, a corporate, you would need to set up the company. But once you've set up from a long-term perspective, the costs then are quite minimal from that perspective for the actual structure as to whether you have an individual or whether you have a company. So some of the running costs of a self-managed super fund. So you do have the fund establishment and the fund administration. Tax returns, you'll have the accountant and advisor fees. Now, in the past, when we talk accountant and advisor fees and the tax return and the audit fees, if you've retired, we'd need actuarial certificates on those, but that'll only be once you're at that retirement. And the ATO supervisory levy. All of those costs, if you were in a retail super fund, they would be part of the fee that you pay to the trustee. So if you're not in a self-managed super fund on this webinar, which I'm sure most of you aren't, that's why you've joined it, have a look at your superannuation statement and have a look for the fees. Now, don't just look at the top level of fees, look for the little asterisks, and then at the bottom it has the fine print. Those are the total fees that you're paying for the administration, for them to do the tax return on the whole fund, the advisor fees to manage the portfolios, the accountants, the auditors. So those fees are all in there. And that's where you find, when we talk about needing 200,000 in your super, the reason we're saying that is from a fee level. 200,000 in a normal retail fund versus 200,000 in a self-managed super fund, the cost of paying for the tax return and accountant, et cetera, yourself, versus the cost of what you'll be paying the manager, the fund manager, to do it, is going to be, depending on the fund, potentially on a par. So that's where if you had 200,000 and your partner had 200,000, if you look at both of your statements, you're actually probably paying more than what it would cost to have the super fund, in a sense, a self-managed super fund, and having your balances pooled and combined together. So that's where if we have a client that says to us, look, I've got 200,000 and I want to set up a self-managed super fund, I'd always be asking, well, why do you want to set up a self-managed super fund? What's driving you? Was it someone at the barbecue told you it'd be a great idea and you should set that up? You know, and if you're looking at just investing in, say, managed accounts, managed funds, or any of those type of investments, I'd be really questioning them just to make sure that they're fully aware of what it means to set up a self-managed super fund. When you've got a super balance of a lot more, maybe you've got a super balance of, say, $500,000, well, it's going to be a lot more cost effective to actually have a self-managed super fund, and you can invest in those managed funds and managed accounts as well. Some clients might come to us with a super balance of 200,000 and say, I want to set up a self-managed super fund because I want to buy this property so I can use that in my business and rent from myself. And that's where, if you had less than 200,000, that's where we might say, okay, understand, or you had 200,000, we might say, okay, that's the reason why you want to set it up. The fees are going to be higher than if you left it in a retail fund, but you can't have a property in a retail fund. So that's kind of the balancing act we go through when we're working through this with clients, to work out the right timing of when to set up that self-managed super fund. I was speaking to a client last week that their goal is to actually, in the next 3 to 4 years, potentially buy a property that they will then run their clinic from. So rather than setting them up in a self-managed super fund today and having those at this stage, given their super balance, additional costs, we're just focusing on over the next few years that they make contributions each year, which, you know, saves tax for them, builds up their super balance, and then at the time they need, we can set up a self-managed super fund at that time, and it saves them the admin in this interim period. So when we talk about investment strategy, when you're running a self-managed super fund, all of a sudden you've got to be like Australian Super or MLC or any of those. You've got to actually come up with a strategy. What do we as trustees want to invest in? Well, probably the reason you've considered a self-managed super fund is because you want to have control over your strategy. And you might want to say, well, I actually want to invest in all of these different types of assets. So that's something that we can advise you as well. But you may actually have a personal preference of saying, I've got particular shares that I want to invest in the stock market. I want to buy this property. So what you can invest in is like shares, what we call ETFs, term deposits, property, managed funds, cash, fixed interest. Some collectibles, you can't just buy that artwork and put it in your self-managed super fund. Some of those rules have been closed down. That was being very popular many years ago. And some of the things to consider when you're investing in these different investments is, what are the risks involved? What are your objectives? So basically looking at, well, how long have I got till retirement? Because as you get closer to retirement, you may get a bit more conservative. If you've got 20 years till retirement, then you're going to most likely, depending on your appetite to risk, be looking at really growth. You know, is it buying a property so that in 20 years time, what's going to be the value? And you might be looking at assets that are going to grow between now and retirement in 10 years or in 20 years. When you're 2 years off retirement, you won't want growth assets unless you're wanting to give it all to the kids as inheritance. You'll be looking and going, well, actually, I need income. So the reason, you'll start to change your investment portfolio, which is why many of you may have heard when the government talked about getting rid of the franking credits in super funds, and there was a lot of retirees who were very, distraught with that. That's because a lot of them were at retirement, invested their money in income generating investments, such as, a lot of bank shares and things where they knew every year I'm going to get these dividends and I'm relying on these franking credits. So you do change over time and your investment strategy will need to change. I mean, one thing on the investment strategy, when you're bringing, if you were to bring kids into your investment strategy, into your self-managed super fund, is looking at it, well, kids are going to be at a different age a different investment or risk profile to you at a different stage of your life. Now, if I look at it from my own perspective and put that into context, at the moment, I'm just a spring chicken, not 50 yet, so another 2 years to go on that. I'm looking at growth. So I'm looking at growth, and so I'm investing in that kind of area. I don't need dividends. I don't need any of that because I'm not retired yet. So I want my assets to grow so that when I get to retirement, I have a high asset base that will then generate income. My kids are also at that growth. You know, they're at accumulation. Let's grow and grow. As I get closer to retirement, I'll be like, hey, kids, you're on your own now. Can you go set up your own self-managed super fund and roll your super into that? Because I want security now. I want income coming in. I'm not focusing on growth, but they're going to be younger and they'll still be wanting to focus on growth at that point. But it does, what I look at it and I go, okay, well, it just means for the next 10 years or whatever it is, they have the benefit of really, they're growing their member balance without having any fees that they'd have chewed up in their, if they had it all in one of these other, these other retail funds. So we work with a lot of clients on, I guess you could call that succession, and trying to work out, well, what's the best option for the overall family? It can be a really good way if you've got an asset in it, and there's nothing stopping you having two super funds. That we've got some clients where there's an asset that they want to kind of keep somewhat in the family in that super fund, and then they've got some of the adult children have got two funds. They're part of mum and dad's super fund and they're part of their own super fund. So those are kind of some of the strategies that we look at with clients in going through it, and it all depends on their own facts and circumstances. So a question that we get a lot is on investing in direct property. So just at a high level to go through, because I could probably do a whole session on investing in property in your self-managed super fund. But just at a high level, you can invest in residential property. There's a lot of people that think you can't invest in residential property. You can invest in residential property in your self-managed super fund, but it cannot be acquired from a member or related party. So you can't own an investment property now and go, oh, I just want to put that into my super. And you can only lease the residential property to an unrelated party. So you can't buy an apartment in the city and then say, hey, the kids can live in it while they're at uni. It cannot be lived in or used because that's using an asset for your super and before retirement, and the ATO see that as a big risk being residential. On the other hand, commercial and industrial property, you can buy that from yourself personally. So if you owned a factory in your personal name or in a trust, a family trust, you could sell that to your self-managed super fund or potentially contribute it in to your self-managed super fund. It's a commercial property, so there are special rules around that allow us to be able to do that. And then you actually can rent it to a related party on commercial terms. I guess the ATO don't see the same risk that you're going to be living in that direct property. So you can. This is a really great way if you are running a business to have it and pay rent to your own self-managed super fund rather than someone else's mortgage, or most likely someone else's self-managed super fund that you're paying rent to. So some of the, you can also, in addition to that, is the borrowing to invest. Now the borrowing to invest, and again, this comes back to, I guess, the age and where you're at in retirement or getting closer to retirement. When I'm working with clients, and we're looking at really growing their portfolio, as a self-managed super fund, I look at it and I think I am happy for that self-managed super fund to kind of borrow as much as it can. If I need 30% deposit for every asset that it purchases, and I have a few clients that kind of are up to their third one, where they get a 30% deposit through contributions they've made and roll over their super balances, and they might buy, say, the first factory, they have a deposit of 30%, they borrow 70%, that's kind of the requirements with the bank lending. And before you know it, because when you look at commercial property, there's not many on costs. The tenant has to pay most of the costs, the rates and things like that. So the landlord really only has to pay the mortgage interest and potentially the land tax on it. Once you've paid that, a few clients find after a year or two, all of a sudden the rent is kind of covering the mortgage, especially at the moment with the interest rates being so low. The rent's covering the mortgage. They've built up the funds to get them in a position where they can now buy the next one. So we get another 30% deposit. Now, when I've got clients in what we call accumulation phase, I'm happy for them to have kind of as much debt as the super fund can manage and self-sufficient, because if I can get them to a stage of a number of assets, when we get to retirement, and this is the beauty of why I'm the biggest fan of super, and I hope the government doesn't change it, is that when you get to retirement, any income you earn once you've converted that from what we call accumulation phase to pension phase, any income you earn is tax-free. Not only that, any capital gain. So let's just say you had an asset, you bought, you invested in another asset, and you got to the point where you had 3 or 4. Some clients are really looking at that point so that when we get to retirement, we sell one asset that hopefully in say 10 years time or 20 years time, maybe that's at a level where it pays off the other debts that we're owing on the other ones. Once you get to retirement, there's no capital gains tax either. So if you held a factory for 20 years, you can sell it the day after retirement and there's no tax payable. So that's why you would have seen over the last 10 years and the ability to borrow and why so all of a sudden, and I'm sure that's what spiked the factory market increase, especially around Mornington and all of those areas, is so many are owned by self-managed super funds because of this type of situation. So it does enable you, being able to borrow does enable you to, to really set that up. And if you've got that plan in mind, you can really, see what your end goal, and we financially model what that means as an end goal. And even when we're doing that, the value of the asset at the time you would sell, we try and use a very conservative, growth rate just to be on the safe side with that. But it really can help you build up as you're going through. It is important when you're going through the borrowing to invest, there is a structure that we do need to set up. It's actually held in, as I'm saying in here, in a separate trust. We call it a BARE trust, which is BARE. And the reason for that is that no one can actually access your super. So even for bankruptcy, anything like that, no one can really access your super. It's completely protected. Now, the banks have a problem with that, because if the asset was held by your super fund and you decide, I'm not going to keep paying my mortgage, which happened at the beginning when they first started allowing their borrowings, the bank can't get the asset. So they make you set up the asset. There's a separate trust, doesn't have to lodge a tax return, doesn't do anything else. It just holds the asset in trust as a BARE trust on behalf of the super fund. And once you pay out your loan, there is no tax or stamp duty consequences of that asset then going into your super fund. So while you have a borrowing, you do need to have this separate trust. And you might hear this acronym LRBA, Limited Recourse Borrowing Arrangement. That's what an LRBA loan is, if you hear that situation. And that's where you'll need to have that separate trust situation. Some of the other investment options that are available to you is you've got managed accounts, managed funds, and direct equities. And I'm going to explain those to you, because the managed account, a lot of people know of managed funds. What your retail super fund would be investing in now is a managed fund. Your money's all pooled together with other investors. A fund manager buys and sells assets, shares, bonds, etc. But you don't own the underlying investments. You only own units in that fund. And that's what all of your retail funds would be now. Direct equities is where you just buy some shares in the stock market, and you might decide to buy certain shares and you own the shares. Now, a managed account, managed account is fairly new, and it's really, really exciting for, I think, a lot of our clients, the managed account. The managed account is basically taking what was originally only available to all of the big banks, your UBS and all of those big investment houses. A managed account was really something that all of them invested in. The likes of your Morningstar, and there's a few others. And so Morningstar, many of you probably have heard of Morningstar as a big investment house, very much leading investment platform that are constantly, they're trading the money of literally the banks and making investments for the banks on a, a daily basis, so to speak. They've created what they call managed accounts, and this has come through over the last few years. And what that means is that instead of having a managed fund where you're just owning units in it, a managed account means your self-managed super fund can own a really, I guess, diversified investment portfolio based on your risk or appetite to risk. It's held through a platform, but it means actually you're getting the managed accounts. You're saying to Morningstar, I'm a growth investor. I have $100,000 and I want you to invest that for me in growth type assets. So growth meaning highly traded assets. Now, every day they will be trading at different times every day, if applicable, round the clock. But they will have not only your 100,000, they might have another 100 people exactly the same. So when they do one transaction, they do it for all of those that are under those similar portfolios, but you actually own the shares. Now, if one day you say, hey, Morningstar, I don't like what you're doing, you can take your share portfolio and go to managing yourself or another managed another provider. So that has been actually fantastic. It's kind of was like, I guess, earth shattering when it came in a few years ago at the fact that we now have access, because none of us want to pay for, I guess, stockbroker fees at the magnitude you need to have someone working on your portfolio every day as a standalone. So I've just put through then a bit of a summary on the difference. A lot of people know about the managed funds. I think not many people know about managed accounts, and managed accounts, it really means a lot of people are, I guess, probably going away from this whole managed funds, and even some of these big investment investors that are saying, look, we'll manage and share stockbrokers. They're moving to more of this because you've got the capability of, say, a Morningstar trading your shares on a daily basis as required, but they're being able to do it on a mass scale for those that are in similar, I guess, investment profiles such as yourself. So it's really cost effective, and have been getting some great returns with clients on that as well. And that gives you a good mixed portfolio. So when you're looking at your investment strategy, what you do need to have as part of the tax office does require, and the auditors require you to have an investment strategy each year. If you think about it, it makes sense. Australian Super, if they said at the beginning of the year, hey, we have no investment strategy, we don't know what we're doing this year, no one would be happy as a member. Now, the ATO looks at your self-managed super fund and kind of treats you a bit like an Australian Super or MLC. So they want you to have an investment strategy. Obviously, we can assist you with that in putting that investment strategy together, but they want to know that you actually thought about what I want to invest in. You actually thought, well, actually, I do want to have X amount in shares, or I do want to have X amount in property. They're not going to tell you what to invest, so you can invest it whichever way you want, but you just need to have it. So you look at your fund profile, what's your investment objectives, what's your plan to do that, and then it's just how you're going to monitor and adjust it. And it's making sure you're thinking about it. And look, good practice, you should be doing that. You don't want to put something into super and then hope it's going to be okay, because a lot of people forget your superannuation balance is going to be this huge asset, ideally, at retirement. It could be anything up to $1 million. Many people have super balances, that just accumulate. And, we want to make sure that you actually, if you had that money in your bank account outside of super, you would be focusing on it. You would be trying to work out, how can I make that money grow? Just because it's in super is not something to kind of just forget about and not consider. So some of the, I guess, the rules and responsibilities. And so, if we set up a self-managed super fund, we do kind of go through these rules and responsibilities, just so you're aware of it. There are some key investment rules that basically the ATO have said, if you've got and there's what we call a SIS Act, which is a Superannuation Act as well. There is the sole purpose test. The whole purpose of this is to fund, your retirement, to save and fund your retirement. There are some restrictions on what the trustees can and cannot do. There are restrictions on borrowings. There are some prohibitions on loans and some securities as well that you can do, and we go through those. And everything that you do must be at arm's length. I'll give you an example of that, which is really crazy. I am not allowed to do my own super fund for free. It is illegal if I do and lodge my own super fund for free. I must charge my own super fund to do it. Everything must be at arm's length. If you're renting from your super fund, it must be done at arm's length. We'll get clients to go to an agent and get a valuation to say this is what the rent would be worth. So everything must be at arm's length when you're doing that. There are some rules around assets from related parties. As I said to you, you can do commercial assets, but you can't do residential. There are also some what we call in-house asset provisions. So that's where if there's you can't have any, I guess, related party in a sense, but borrowing of some of those assets, or if there are some of them that may be, I guess, deemed to be. If you've got, usually this one kicks in when you've got like a trust underneath your super fund. So maybe you've got a separate trust that's investing in another asset as well. Then these in-house asset rules can kind of apply from that perspective. So we kind of go through some of those just so that you understand them. The key thing is, which I often say to clients, often you might set up a bank account. And you'll log into your own bank, your bank account, and the super fund will be just another bank account. I always tell people to internally name it, SMSF, do not touch, or something to make sure that you don't accidentally transfer from one account to another inadvertently as well. Some of the end of year obligations. So you are required to do an independent, have the independent audit. So we get the auditors to do that. We work with the auditors so you don't have to bother. There will be some things that will say to you, hey, we need this from you because the auditor is asking. It's not us being annoying, it's the auditor. But the auditor needs to check the invoices for everything and make sure that you've actually only spent things in relation to your investments. You'll need an annual tax return. The actuarial certificate, that's only required when once you've retired and if you've got different segmentation of assets. If you have a commercial property, potentially you might need to do a quarterly BAS and on that. If your super fund is in a positive income because of your contributions, etc., you will have probably PAYG taxes that you'll need to pay each quarter. As part of your end of year, when we do your tax return and your accounts, we prepare the member contribution statements, if there's any different ones, if there's any what we call these transfer balance caps, and then also the end of year financial statements. Once you're at retirement, there are minimum pension payments that needs to be taken out. There's a minimum each year, depending on your age, that once you're in retirement, so your income is 100% tax-free, you must start drawing down on your pension at that point. So we assist clients with calculating what their minimum pension payment is for that coming year. So just on some of the areas on contributions and making contributions and these contributions, this works for, I guess you could say, the retail and self-managed super funds, but it's often a question that I get coming up. So you've got a few different types of contributions. So you've got non-concessional contributions. They really should have just named it non-deductible contributions. Non-concessional contributions are where you're taking money from outside of super, which is a taxed environment. So if you had a term deposit and you've got 100,000 in a term deposit, if you earn interest on that, you're going to be paying tax at your normal marginal tax rates. You can take that out and put it into your super fund. There's no taxable income when you put it into your super fund. There's no tax payable by your super fund, but there's no tax deduction either. But you're actually being able to take money from a high tax environment to put it into a 15 cents in the dollar taxed environment. You've then got concessional contributions. Now, concessional contributions, again, should have been called deductible contributions. Basically, you're allowed to, at the moment, the rules say $25,000 is able to be contributed to your super fund. It's a tax deduction for you, and it is taxable at 15 cents in the dollar when it goes into your super fund. So this is where, depending on your income level, you might want to make extra super contributions yourself personally to be able to actually get, say, the tax saving at the highest tax bracket and only 15 cents in the dollar once it's in super. Now, if you do earn over 250,000 a year, there is an slight extra tax to bring that up to 30%. That's what we call a Div 293 surcharge. So if you're under that, and if you're running a business, we try and I guess play with your income to make sure you're under that and you don't have that extra tax, tax payable on that. The $25,000 does include employer contributions. So if you're an employee and then you make extra contributions, the total is 25. There is this new one that's only been around just over the last few years called a downsizer contribution. And this is more looking at those close to retirement who downsize their house. There's a few different requirements, like you must have lived in the house, it was your primary residence, and you can actually take proceeds from that and put $300,000 in, because on the non-concessional, there are caps on the non-concessional. You can do a non-concessional $100,000 a year, or you can bring forward 3 years worth and do 300,000 in a sense today, and then do none of the 100,000s for the next few years. But you can still do your concessional contributions of 25,000. So these types of strategies are some of the things that we look at when we're going through with clients to work out how do we get enough money into our super tax effectively, but also to enable your goal if you're looking at, say, buying a property or investing in a particular investment, and what's going to get you to the right outcome on it. Now, when I look at then another one, this is fairly new as well, that many of you may not be aware of, is unused concessional contributions. Now, what it used to be is if you didn't pay that 25,000 in contributions by 30th of June, you missed out. And, if you only put in 20,000, well, you missed out on ever being able to put that $5,000 in. What the government have come out and said is, if your superannuation balance is less than 500,000, we want to help you build it up. So we're going to allow you, from the first year ended 30th of June 2019, you can actually, if you only put in $10,000 as at 30th of June 19, you can put in that extra 15 that you would have been allowed to then. You can actually put it in today and carry it forward from starting from the 1920 year and continuing, and you can use those unused amounts for up to 5 years, and it's a rolling 5 years. So then in a year's time, there's only 4 years remaining on that one, and then it keeps rolling forward. And so that means that basically if you had only done, say, 10,000 at 30th of June 19, 10,000 at 30th of June 20, normally it would have been bad luck, you've missed out, no deduction. What you can do now is you can do 15,000 contribution from 19, 15,000 from 20, and you can put that 30,000 now, today, in this 2021 year, plus your 25,000, and get a tax deduction. So that's been really exciting for us, because we've actually had some strategies where we've looked at it and gone, hang on a minute, we've got a big capital gain for a particular client. Not we've got, like maybe not this year, but next year. So why don't we just put in the minimum, and next year we'll put a big chunk to reduce their income down below a different tax bracket to really get them some great savings. So if you haven't put much into the super in the last 2 years, this is an opportunity to have that catch up, provided your balance is under 500,000. So it's really great to put all of this money into super. When do we get our hands on it? And it is a balancing act. When you are doing this, it's really good to build up your super balances, because we all want to retire comfortably and have enough money. The only problem is you can't access it until you reach preservation age. Now, they call it preservation age. For generally, that's going to be 60 for most of us. There are some people that are in this transition phase for 6 years worth of, I guess you could, an age bracket of 6 years worth of people that have certain age limits because they've changed the preservation age. So there's a bit of a kind of transition period. But for most of us, probably on this webinar, it's age 60. So it's really good to put a lot into super. You've got to balance it with enjoying life today. Enjoying life, making sure that even if you said, well, hey, I might actually choose to not work as much at age 55, well, what are we going to do between age 55 and 60? What investments can we kind of get built up for you so that you can fund yourself not working as much between age 55 and 60? And then at 60, we're okay because we access our super at that point. So you need to satisfy the conditions of release. It can be released earlier if you temporarily or permanently incapacitated, severe financial hardship and compassionate grounds, or the government decides you can access 10,000 before June and after June, which was most unexpected, a policy I would not have expected them to do, but I guess they did it. That's when, there's only very rare occasions that you can access it before then. When you're wanting to do that, if it's with a retail fund, you'll fill in the paperwork and ask for that to be done. If it's a self-managed super fund, we kind of do all of that paperwork, and you literally just go into your bank account and take the money out that you want to take out. Now, when you're at retirement, and this is where some of the strategies can come in, you can actually take a lump sum, or you can take a pension, or a combination. So we have some clients that might have an investment property in their own name that they've been negative gearing all these years while they've been working, and that's been working really well. We've said to them, look, keep it on interest only, we'll pay it off, and I want you to put heaps of money into super as you're going. I'd rather you get a tax deduction. At retirement, the first thing we're going to do the day you retire, we're going to draw down a lump sum and pay off that debt for that investment property so that it becomes positively geared, and you get income from that, and you get the pension from within your super. And then that will be the ongoing. So there's some real flexibility on once you retire on getting that lump sum incoming through from that perspective. So some of, like, if you're looking then at creating kind of an action plan, hey, I'm looking at doing a self-managed super fund, what does it mean? Get professional advice, understand the trustee obligations. No, you're not going to love it as much as we do, but just understand some of those requirements. And really it's about knowing that you can't, as I like to say to clients, you can't use your super fund's bank account as appealing as the money in it looks. It's not your slush fund. We've had clients that did do that, and that didn't end well with the ATO auditors. So we don't want to have that situation. Establish your fund, choose the structure. We'd always be recommending a company, set your investment strategy and select them, and then basically choose your contribution levels. And a lot of that is interlinked when we're financially modeling it to say, well, ultimately, what is it that you want, kind of in a sense to retire on? What's your ultimate, I guess, retirement goal that you're trying to get to, so that we can set the investment strategy to achieve that, but making sure it's kind of consistent with the ability for you to sleep at night. There's no point. There are some people who are not growth investors and would rather see things, not completely under the mattress, the money under the mattress, but would like to actually just have a more of a balanced approach. So it's got to be about, what your personal preference from investing. And the interesting thing is with a retail super fund, many times when we get those documents, clients actually haven't even realised how their money's been invested. It's been done by the super fund. They probably filled in a form a long time ago. But I guess even getting a bit more engaged and having a look how that's been done. We can look at how they're managing the costs and reducing the tax side of it. And there's been some clients that have come to us and said, hey, I want to set up a self-managed super fund. I've looked at it and I've gone, well, unless you're buying a property, at this point, it's not cost effective for you to set up a self-managed super fund. Let's work out a strategy, if that's your end goal, of getting money into super, but balancing it. So it's not, it's not just a one size fits all. Look at your review super contributions, really assess your insurance cover and make sure you've got that right. And then we try and keep you up to date if there's any changes in the regulations. Things like, now you can have 6 members. I've got a lot of clients who are like, woohoo, now I can put my kids in because they had, more than 2 kids. So that makes it a bit easier. But also some of the changes in the amount that you can contribute to your super, the fact that you can do these unused contributions. So we try and keep people up to date from that perspective. But they're some of the key, hopefully that's given you a bit of a framework about what a self-managed super fund is, what it is that you'd be, in a sense required to do, but what are some of the benefits of it, and just knowing that there will be a little bit of admin. We can help you a lot with the admin, but there will be some things that you need to do as far as maintaining some of those records. But it does give you that ability to probably really feel, I guess, a bit more actively involved in growing your retirement and kind of like moving towards your I guess your goals, the retirement goals. So I'm happy to answer any questions that maybe anyone's got. Any questions at all? I've got just one that's come through. Someone's asking if I've got a balance of 150,000 and my husband has a balance of 80,000. So can we set up a self-managed, or is it going to be more cost effective for us to set up a self-managed super fund? So I guess the benefit of when you're going into a self-managed super fund is the fact that you know, I don't get paid more as an accountant or auditor the number of members that you have, generally speaking. So you have a fixed cost of accounting, audit, and then the fund managers, often that's related to, or the managed funds. I mean, if you've got a property, you know, then you're not paying a fund manager for that. So it comes down to the cost effective. I mean, what you would look at with that point of view is, well, what's one of the reasons why you want to go into a self-managed super fund? And then also what the costs are of what you're paying now. And so we always weigh that up and get all of the details on your self-managed super, on your retail fund to work out the cost to make sure that it's going to be more cost effective for you from that perspective.
Yep, we've got another question, Shannon.
Yep.
What insurances can I hold in a self-managed super fund?
Yep. So on your insurances, so you can actually, so super funds, and this would be the same. This will be the same from the perspective of your retail fund as well. You can have life insurance, TPD, and also income protection. But I'm just going to go back to one slide now, and this is probably one of my pet frustrations with many of the older style financial advisors. Okay. Which is probably why they did the Royal Commission to clean things up. Now, if I go back to accessing your super, so life and TPD, it's tax deductible in your super fund. You wouldn't want to own your life and TPD insurances outside of super because you don't get a tax deduction personally. Trauma insurance, no one gets a tax deduction. You hold it personally and no one gets a deduction. Income protection, I always cringe every time I see a client come in with income protection in a super fund. So if you've got income protection in a super fund, whilst the super fund gets a tax deduction at 15 cents in the dollar, if it was in your own personal name, it's tax deductible at whatever your tax rate is, which could be up to nearly 50 cents in the dollar. Not only that, let's have a look at the condition of release. So let's just say you were eligible to get your income protection insurance, you know, something happened and you were able to get it. You haven't reached retirement age. You're not at preservation age 60. You may not be permanently incapacitated. Maybe you're only going to be on income protection for 2 years. You may not face severe hardship. Things are not great. And so you actually may get the income protection going into your super fund, but you may not be actually able to get it until you're 60. So you can hold those three insurances, but I generally wouldn't recommend income protection in there, but I frequently see income protection within super, which I find very frustrating because I think sometimes the broker may have sold it to the person saying, oh, here's income protection insurance, it's in your super, so don't worry, you don't have to pay for it. Because I think a lot of people look at the cash that they've got outside of super and don't think of that their super is their money as well, ultimately.
Okay, and we have another question. Can we have more than one loan in a self-managed super fund?
Yes, yeah, you can have as many loans. That's actually a really good question because I didn't touch on that point. You can only have one loan for each asset. So you can't even build up equity in another asset and borrow against the equity in that asset. It's one loan, one asset, one loan, one asset. So and they have to have separate those trusts that hold the assets outside. But each asset can only have, you can only borrow legally, you can only have one loan for each one asset.
Okay. And one other question, can I use a residential property at retirement that has been held in a self-managed super fund?
Yeah, so that's actually something that's kind of a bit of a planning when you look at a long-term goal. You might buy, and I've had one client do this a number of years ago. They bought a property, the worst house in a great location right on the water. They actually bought it more than 10 years ago now. They're not retiring for another 15 years. So they bought that and it's in their super and they're just renting it out, and their goal is they'll get to retirement. And when I talked about taking a lump sum, their lump sum is going to be that property. So all this period now, they've actually had it in their super, and their thought process is when we get to retirement, we will take a lump sum out, and that lump sum, they'll still have extra money left over with other investments. That lump sum will be the value of that property. So instead of taking cash, we'll tell our super fund, hey, don't pay us the, $1 million cash. We'll take the $1 million property instead. Their intention is to take it out. Now, you do have stamp duty, but that's probably a minor cost, and there's no capital gain on that too. So remembering that asset you've been paying for it with superannuation contributions, that you've been getting a tax deduction at the higher rate, you've been paying a lower tax rate, you can get that asset, pay your stamp duty because you're changing title, but there's no capital gain because you're retired. So you can actually get that asset out. So like in that example, they're intending that they'll take that out, tear the house down, build their dream house on the water, and that's where they'll live in retirement. Yeah. Any other questions, or is that's it?
No, that's all.
Yep, that's great. Oh, thanks everyone for joining. If you do have any other questions, feel free to reach out. There's a lot of exciting opportunities with having a self-managed super fund, but you've really got to make sure that you're ready for it. Hopefully, for some of you, this might be just planting the seed, for in the next 2-3 years. This might be something you think about doing now. Often what you will find with the financial advice side of things, when you go to borrow money, just that's probably one note to have. When you go to borrow, the bank will ask for proof that you've seen a financial advisor and that you've done financial modelling, that you are in a position to be able to afford it. So the banks are starting to try and put that onus back on that. So that's where, when we're preparing the advice, that's where you might find that even if you've gone and set up a self-managed super fund and then you go to borrow and you find the bank wants the financial advice on it. But yeah, feel free to reach out either to myself or Bianca. One more. I've got an investment property not in super. What's the benefit of transferring it to an SMSF? So if that is that property, can that person just reply back? Is that a commercial property? If that person that's done that, can you just put a note whether that's a commercial property? I'm going to assume it's a commercial property, because if it's residential, we can't move it into your self-managed super fund because we can't buy between related party. Oh yeah, so if it's residential. Yeah, so with the residential, that one we can't transfer it into a self-managed super fund because it's residential. The rules don't allow on residential. If it was commercial, and we've done this a number of times with clients, they've owned the property in, say, a family trust, which is a commercial, let's just say a factory. We're doing one at the moment that we're transferring at the moment. Now, the benefit of it, if we're transferring that now, we might have a small capital gains. Now, if that factory, and the example I'm thinking of now that we're transferring now, has been used in your business, there are small business tax concessions that enable us to transfer that property for no tax. So we can get a capital gain and roll it over under these small business tax concessions and actually have no tax outside of super. We transfer it into your super, we get it in at market price, whatever it is today. For some clients, that's released a bit of extra cash flow coming to them because of the fact that, they've actually sold it to their super and they've been able to get the funds at market price today. We were able to get it with no tax, and they were able to pay down the debt on it. And you're locking in, I guess, at that point today. Now, if you've got not retiring for, say, 10 years or 20 years, the growth in that asset at that point now is going to keep growing. And you're going to get, by retirement, it would be tax-free if you sold it at that point, or your income from a residential, the income that you're earning is going to be taxed at 15 cents in the dollar, and once you retire. So there's some real benefits of getting property, if you're owning it now, into your self-managed super fund if it's commercial. Fortunately, the rules don't allow residential. That is just specific superannuation rules. I guess the government thought that people would use their super funds to buy residential property the residential property and then live in it and things like that. So yeah, someone's just said I've got a commercial property which you rent to your business. Yes, yeah, you probably should look at transferring it potentially, because there is, if we can get you under the small business tax concession, so you can actually kind of sell it today with no tax consequence, and then you get it in there. There's some real benefits on that side.
One other question about children becoming contributors to an SMSF.
Yep.
And if they live beyond the parent, will the SMSF still be able to continue on?
Yes, so that's the corporate trust. That's the corporate trustee. So upon death, and this is where this is the succession planning, and I guess you could say balancing act of it all, is that if the death of one of the members, that requires the funds to be paid out. So this is where insurance is important as well in it. But if you have just an asset and there is one of the members does pass away, their asset, their member balance needs to be paid out by the fund. So then there needs to be an ability for the fund to be able to do that and have that cash flow. So it can keep going on. And that's where there's that succession planning, where some families want to keep an asset in the family and keeping it going. And, I've got one that we've been working with a bit now that, the parents have had the super fund for a long time. The kids joined it about 10 years ago. And, the parents have now got a second super fund because they still want to be part of that main property asset that they've got in there. They've started now a separate super fund where they've rolled over some of their balances into there because they want to invest it differently. But yeah, if you do have the death of one of the members, they do have to require their balance to be paid out. That could cause some problems if you only had one asset and you need to pay half the money out. How do you do that? Or do you have to actually get a borrowing on that asset for that full amount, which the super fund may be in a position to do. Okay, any other questions?
None at the moment.
That's great. Oh, well, if anyone thinks of any other questions later, feel free to reach out. I mean, obviously all the questions we've gone through, I have to say general advice, because ultimately it comes down to like everyone's situation on what you want to do from a retirement, what your appetite to risk is, what your plan for the next 5 years, 10 years, your personal situation. There's a lot of other factors. And I guess that's why the government turned around and said, well, look, self-managed super funds, it's not a one size fits all. It's a financial product and it needs to be treated just like every other kind of investment. But yeah, let us know if you have any other questions. By all means, reach out and we will be able to assist you. So thanks very much, everyone, for coming. Just one more question. So family SMSF, each member can invest in assets of their own choosing. Not necessarily, because it's the super fund investing in a pool of assets, and then you own a member balance. But you would actually say that each family member could actually help influence the investment strategy. But it's not like the self-managed super fund. If each member had, let's just say you had 4 of you, and you all had balances of 250,000 each, you may actually only be invested in 1 or 2 assets, and each member doesn't own that piece of the asset. They own 250,000 of the total pool. So it's not that they own each separate assets. It's just that the member balance. If you think about a retail fund that you're with now, like an Australian super, it owns, shopping centres, it owns shares, investments, and then you are a member. You're just one member, and your balance is what you own of that. So you don't actually own its own assets for each member, but each member as an investment strategy could be influencing that. Okay. Yeah. Any other last minute questions?
Got a thank you.
Yep, that's good. Great. Okay. Thanks very much, everyone. Have a great night.
Thank you.